What's up, guys? It's Wiz. Today we're diving into a crucial topic for long-term investors, stocks that you can hold onto forever. Finding truly reliable forever stocks is not easy. They are rare, and it takes a keen eye to recognize them amidst the ever-changing stock market landscape. But when you do find them, they can offer stability, growth, and consistent passive income, making them ideal for building a robust retirement portfolio. Retirement can be an intimidating phase of life, especially as your active income comes to a halt. You may worry about whether your retirement savings will last through economic downturns or inflation will erode your purchasing power over time. However, by investing in fundamentally strong companies with steady, low-risk business models, you can continue growing your wealth even in bear markets. These investments can provide reliable returns over the next 3 to 5 years, helping you lock in higher passive income and protect your financial future. Regardless of your current financial situation, whether you're amassed $1 million retirement fund or you're working with a more modest 100K, whether you plan to retire early or at a traditional age, whether you're still paying off debt or completely debt-free, these stocks could serve as essential components of your long-term investment strategy. When you're approaching retirement or have already retired, your investment priorities shift. You need stocks that provide immediate and consistent payouts, dividends that grow over time to keep up with inflation, and a level of safety that ensures your invested capital remains secure. The average retirement period is around 20 years, assuming you retire at 65 and still live until 85. However, in today's world, many people live beyond 85, obviously, and it's essential that your investments continue generating passive income for as long as possible. So today, let's take a look at 5 stocks that can help meet these critical investment goals. First on our list is TELUS, one of Canada's largest telecommunications companies. The company generates stable, recurring revenue through its subscription-based model, providing essential services like wireless communications, internet, and television. Since people rely on these services daily, TELUS is resilient to economic downturns and market volatility. One of the most attractive aspects of TELUS is its impressive dividend track record. It has been consistently paying dividends since 2002 and has managed to grow them in 21 of the last 24 years. That means if you invested in TELUS at the start of your retirement, you could have enjoyed steady and increasing passive income throughout your retirement life. Looking ahead, TELUS is well positioned to maintain its dividend growth, aiming for a mid-single-digit increase annually over the next decade. In today's digital age, telecommunications and internet services have become an essential as utilities, further solidifying TELUS as a long-term defensive stock. Additionally, with its stock price currently sitting at a 9-year low, investors have the opportunity to lock in a high dividend yield of over 7 to 7.5%. Next up is Enbridge, a Canadian energy infrastructure giant. Enbridge operates a vast network of pipelines that transport oil and natural gas across North America. Its business model is largely insulated from commodity price fluctuations as it generates revenue through long-term contracts with energy producers rather than relying on direct oil and gas prices. Enbridge has been a reliable dividend payer for over 60 years, with an astounding track record of increasing dividends for the last 30 consecutive years. This kind of stability makes it a perfect addition to any retirement portfolio. Currently, Enbridge trades at around $59 to $60 with a dividend yield of around 6.3%. However, if the stock dips to around $55 in the middle of the year, a pattern seen in previous years, it would be a fantastic opportunity to lock in a higher yield of around 7%. Winter months generally break peak demand for Enbridge's services as heating needs increase, obviously, boosting the company's revenue. Meanwhile, summer tends to be a slower period, making it an excellent time to buy the stock at a discount. Enbridge maintains a payout ratio between 65% and 70% of its free cash flow, ensuring it has that flexibility to continue paying dividends even in times of economic uncertainty. CT REIT is another high-yield stock with a current dividend payout of over 6%. Unlike traditional stocks that pay quarterly dividends, CT REIT distributes dividends monthly, which can be appealing for retirees looking for frequent income. The company's primary tenant is its parent company, Canadian Tire. This unique setup provides CT REIT with a stable rental income stream, as Canadian Tire is unlikely to default on rent payments. Additionally, the REIT enhances its earnings potential by acquiring and developing new retail spaces, leasing extra space to third-party tenants, and optimizing existing locations. While CT REIT offers a strong income stream, investors should be aware of its concentration risk. For example, if Canadian Tire were to experience financial trouble or reduce its physical store footprint, CT REIT could face a declining rental income. However, such risks usually present early warning signs, allowing investors ample time to make informed decisions and adjust their holdings accordingly. For those who are still in the accumulation phase of their retirement savings, investing in growth stocks can help increase your wealth before transitioning into income-focused investments. Descartes Systems and Constellation Software are two resilient Canadian growth stocks that have consistently delivered a 5-year compounded annual growth rate, CAGR, otherwise known, of around 20%, which is yearly, right? So it's one of the top numbers out there, and it's great. Descartes provides logistics and supply chain management solutions to businesses across various industries, including airlines, e-commerce, and oil and gas. The increasing complexity of global trade, tariffs, and customs regulations fuels demands for Descartes solutions, ensuring steady revenue and earnings growth. Meanwhile, Constellation Software follows a unique business model of acquiring and managing vertical specific software companies. By reinvesting cash flow into additional acquisitions, Constellation has successfully leveraged the power of compounding to drive long-term stock price appreciation. Both companies offer relatively low-risk business models and a diversified customer base, making them excellent choices for investors seeking consistent capital growth. So here are my final thoughts. When investing for retirement, it's crucial to choose stocks that align with your financial goals, whether that's generating reliable passive income, preserving capital, or achieving high growth returns. TELUS, Enbridge, and CT REIT are excellent dividend stocks that offer stability and strong yields, while Descartes Systems and Constellation Software provide opportunities for significant capital appreciation, even in the short term, but long term is the must, right? So as always, be sure to conduct your own research before making any investment decisions. Let me know in the comments if you have any questions or if there are any Canadian stocks you'd like me to analyze or talk about in the future. Expanding our knowledge together is a win-win situation. If you enjoyed this video, be sure to leave a like. It really helps grow the channel. Thanks for watching. I'll see you guys in the next one.